Welcome back, everyone. It's Thursday, November 20th, and unusually, it's a non-farm payrolls day. Because of the government shutdown related delays, the US will finally release the September jobs report later today. According to the latest updates, October's data may not be released at all, and November's figures might not arrive until mid-December and after the next FOMC policy meeting. So while today's figures could spark some short-term volatility, keep in mind that they are already outdated and perhaps unlikely to shift expectations for steady interest rates in December unless we get a major downside surprise in payrolls or a meaningful upturn in the unemployment rate. Currently, the market is looking for 50,000 jobs added in September, with the unemployment rate holding steady at 4.3%. That's not a great report. It's not a very impressive one. It's looking quite neutral if indeed the numbers follow expectations. But let's see what the data could mean for the charts. And at this video, I have prepared my technical analysis on dollar yen, dollar Swiss franc, and Bitcoin against the US dollar. So let's first have a look at dollar yen. As we can see, the pair had an impressive rally as Japan didn't use verbal FX intervention in the face of the deceleration in the Japanese yen currency. So the pair felt comfortable to continue higher and towards the 10-month high, 157.76. However, we can currently observe some weakness. The price seems to be creating a doji candlestick just around its recent highs, and given the fact that both the RSI and the stochastic oscillator are already above their overbought zone, there is opportunity for a pullback towards the 155.70 number, or even lower towards the 20-day moving average, 154.30 zone. That line has been acting as strong support for the market since October. So that area might attract significant attention. If the price moves lower, then the next pivot point could happen near the 153 number. While such a pullback could come in the event the data surprised significantly to the downside, calling for a December rate cut. The odds are currently around 70% for steady interest rates, so the data should surprise significantly in order to change sentiment over rate cuts. Now, if in the event the figures surprise to the upside, suggesting more or less stable labor market, dollar yen could move towards the 158.80 zone in hopes that, or in expectations that the Fed may not cut interest rates this year, and perhaps will leave policymakers to decide based on upcoming data next year. A steeper increase could then meet the 159.80 and 160 zone taken from early, actually taken from summer 2024. Now, looking at dollar Swiss franc, while the pair also turned up this week, but its rally has been more moderate. We can see that the price is currently still within its long-term sideways pattern and below the previous highs, particularly the 38.2% Fibonacci retracement level of this downfall over here is currently keeping control, currently keeping upside movements. And if we look at the technical indicators, it seems that there is chance for additional gains, but I believe that the price should stage a much aggressive rally in order to overcome key obstacles around 0.8150 and even the 0.8230 number taken from June. A successful penetration higher and beyond the 200 exponential moving average could boost market sentiment, likely causing a more sustainable rally towards the 0.8335 number. And in this case, we could have a confirmation of this inverse head and shoulders pattern that was created around the more than decade low of 0.8728. Now, in the event the price fails to close above 0.8075, then the 0.80 psychological mark, where the 20 and 50-day moving averages are placed, could cause some stability. The 0.7935 number, where the short-term support trend line is placed, could also protect the market from reaching the key base of 0.7825 and 0.7965, a break of which could resume the bearish trend in the market, the long-term downtrend that started at the start of this year. So failure to hold there could dampen market sentiment, likely confirming additional losses towards the 0.77 level. And finally, looking at Bitcoin, which also faced significant deceleration over the past couple of weeks. So we can see that the price is currently trading near the lowest level since April at 88,578. Liquidity concerns following expectations that the Fed may not cut interest rates, and concerns around AI-related stock valuations. Those have been adding pressure on Bitcoin. Of course, looking at the technical indicators, we can see that the indicators are already stabilizing in the oversold zone, suggesting that perhaps this downfall is already overdone. But for a bullish outlook, we would need a much stronger rally, a steeper one, probably beyond the 100,000 territory, where the 20-day moving average is currently placed. Below that, there is a former support constraining line at 98,000, which we should also surpass. And in the meantime, the 92,230 zone could also be a key obstacle to upside movement. So overall, we need a much sustainable rally beyond 100,000, beyond the 100,000 level, and perhaps a break above the 103,730 number, where this tentative resistance trend line that could also help the price to put that downfall into question, to violate this downfall, and therefore call for an upside reversal. But for such a move, we would like to see probably the US dollar weakening again, perhaps on the back of weaker data releases, and in this case, we would also like to see rate cut expectations rising, not only in December but also next year. So that's everything I wanted to share with you guys. Thank you for watching. We'll be back next week with more technical analysis updates. So thank you for watching, and wish you have a great trading session. Bye bye for now.